Hello and welcome to Macro Pulse. Are we done cutting interest rates in South Africa and in the US, or do we expect further cuts later this year? Do we remain constructive on the South African economy given all the different headlines that we saw over the last few weeks? And will this market continue to suffer given this current global policy uncertainty that we're seeing? Let's start by focusing on the Fed. They've met on the 19th of March and they've decided to hold rates at 4.5%. They've also trimmed their growth outlook from 2.1 to 1.7%, and they've upped the inflation outlook, the core PCE, from 2.5 to 2.8%. So you can clearly see that there was some signal of potential stagflationary risk in the horizon. Lower growth, but also higher inflation. However, the Fed did acknowledge that this increase in inflation is mostly due to potentially the tariffs having an impact on prices, and therefore they're willing to look through that and not necessarily reacting by hiking interest rates. In fact, they continue to show that they will cut rates twice this year. In our own view, we take it one step further. We think that the US economy will slow down further, and therefore we believe that there will be more cuts coming by the Fed later this year. This obviously will have an impact on gold because real rates will be coming down, and also the US dollar could be weakening further. When we move to South Africa, we met on the 20th of March. We also held rates at 7.5%. 2 of the 6 MPC members, however, did vote for a cut. The rationale for the hold was mostly because of the global uncertainty that we're seeing. We're seeing that the US-South Africa relationship has been deteriorating and will most likely lead to some trade restrictions in the future. We also see that the global policy uncertainty could still be having an impact in emerging market currencies. And so the SARB decided to hold rates. However, the environment and the rationale for cutting interest rates, we believe, is definitely rising and building momentum. We see that inflation remains low. In fact, the SARB, their own forecasts have downgraded inflation for this year from 3.9 to 3.6%. And if you look at the last 14 prints, only once of the last 14 months, you had inflation surprising to the upside. So inflation is definitely still one of these factors that could surprise to the downside. We also see that inflation expectations remains fairly low, and that the rand, despite all the headlines, remains fairly resilient. Growth has also been very weak. And so we think that, like the Fed, the SARB will potentially cut more than the market is currently pricing in. Staying with South Africa, we have been quite positive about South Africa for the last year or so. Last year we had the formation of the GNU. We saw improved outlook on the electricity front and also better backdrop for South African consumers. However, the risks to growth has definitely shifted more to the downside. Reforms has been slow. We've seen a little bit of load shedding coming back into the picture. We've had the relationship between the US and South Africa deteriorating, and we've had some of the aid from the US being cut. The GNU honeymoon is definitely over. Even on the consumer front, the most recent VAT hike does put a little bit of tightness into people's pockets. So why do we remain more positive about South Africa? Well, growth is purely a function of consumption, investment, government expenditure, as well as trade. And we think from a consumption point of view and from an investment point of view, there's still some upside. On the consumption side, or the consumer side, inflation remains low. We see that the oil price in rand terms is also moving low, which could potentially lead to lower fuel prices in the future. We can also see that the two-pot system, which has been beneficial, remains in place and will continue to potentially drive consumption higher. And we've seen retail sales and passenger vehicle sales kind of showing that we have had a better backdrop for consumption. Wages in real terms is also still positive because wages are rising above inflation, which is also helping on the consumption front. And then from an investment point of view, there's definitely appetite as well as willingness to increase infrastructure spending in the economy. On the network economies like rail, ports, and electricity and the water front, we're seeing more investment shaping up. So we believe that the economy, local assets could still benefit in this environment where we've had some global uncertainty and South Africa could provide some defense. We can go back to 2021, 2022, when we also had a period of stagflation. You had US growth softening, but inflation still rising. And in that period, you've had commodities doing fairly well, which has benefited South Africa. And the SA equity market has actually been quite resilient during that time frame. So if we are going back into some sort of a mild stagflation environment, South African assets could again provide some support. On the policy front, we've had many headlines from the Trump administration in particular speaking out against South Africa. But I want to caution that South Africa is not unique in this environment. The US and the Trump administration has been vocal and has put a lot of pressure on its own allies, and it's challenging its own allies in this environment. So when you think about the market as a whole, we do think that the recovery that we've seen, or first of all, the drawdown that we've seen and the little bounce that we've seen, is probably not going to see it bouncing all the way back to its previous highs. We do believe that we will first have to see a much improved backdrop in terms of policy certainty before we will see markets recover meaningfully. And in that regard, we've just seen over the last 24 hours that Trump has announced a 25% tariff on auto imports into the US. That will kick in on the 3rd of April. And then it's also put a tariff on auto part imports into the US, which will kick in on the 3rd of May. On top of that, you will also on the 2nd of April announce the reciprocal tariffs, which they've highlighted now for the last month, that they will tariff countries which has got a higher tariff on US goods that they import into their country. They will tariff those countries at the same rate as which they are being tariffed, which means that you will see ultimately tariffs rising anything from 5 maybe to 10% across different countries. We'll get the details out next week on the 2nd of April. We're not yet sure whether the implementation of that will be immediately. It could be that Trump wants to use this as a negotiation tactic and want to extract concessions from countries. And therefore, there could be still weeks or potentially months of uncertainty around different countries and the implication that these tariffs may have on their economies. Apart from that, there's still the threat of broader tariffs on Europe. There's still an investigation going on in terms of putting tariffs on the likes of copper, timber, lumber, and this has helped commodity prices. So in this environment of potential tariffs on some commodities, we've seen commodities actually doing fairly well, again, potentially benefiting South Africa. So with all of this, the question is, where can one hide in this very uncertain political environment? And gold has been the true anti-fragile asset throughout all of this. The last few months, or the last year, at least gold has performed more than 40%. And since the beginning of the pandemic, early February 2020, gold has actually outperformed the S&P 500. So with this rally in gold, the question now is, can gold hold up? What is next for gold? Now we do recognize and realize that there could be some retracement in the gold price. It has had a very good rally, and we could see gold prices falling in the short term. But if you think about some of the long-term structural factors, we are still constructive on gold. Back in 2022, with the Ukraine-Russia war, the US started to use the US dollar as a financial weapon. Central banks noted this, and they've started to diversify their reserves away from the US dollar into the likes of gold. And so gold as a percentage of reserves has moved up from 10% to about 20% before the pandemic up until now. And we continue to see central banks buying gold as a diversifier towards some of these uncertainties. Gold is a very good diversifier, very good asset when we go into some global geopolitical uncertainty or geopolitical event. But this event which we are experiencing at the moment is very different. It is the fact that the US, the global superpower, the Trump administration, is putting pressure on its own allies to the extent that it is risking their trust in the US. And if you don't trust the US, you can still trust gold. And so we are seeing that movement shaping up. We're also seeing some other factors at play here. Some investors do not trust that bonds could still provide them protection in a downturn because of some fiscal concerns in the US, and therefore they prefer the likes of gold. And in an environment we will see lower real rates and also weakening US dollar, which we think will play out over the next few months, gold should also do well. On top of that, if we are seeing an improvement in China as well as in India and their consumption starts to improve, it will also provide some demand to gold. So we do think in this environment, a lot of uncertainty, that gold remains an anti-fragile asset. Thank you for watching. See you next time.